Two experts joining us on the show, Alastair Newton of Nomura and David Lubin of Citi, to analyze the impact and the road forward. That's essentially important for financial markets. Alastair, let's start with you. A resounding no for austerity from Greek people. How are you reading this? And for many, this was the referendum that would decide Greece's future in the Eurozone, isn't it?
Well, I don't think one should interpret it as a vote to leave the Eurozone, which some European politicians were claiming last week. This was a solid anti-austerity vote, not an anti-euro vote. Bear in mind that the question didn't even have the word euro in it. So the Greeks will not have thought, in all likelihood, that that was what they were voting on. Anti-austerity, not anti-euro. At least 61% of Greeks appear to believe that they can have the euro, but they don't have to have austerity.
David, let me come to you then. And of course, Alastair says it was a solid anti-austerity vote, but not an anti-EU vote. Is that how you read it? And what are you sort of, assessing in the way the market perhaps also read this landmark vote?
Well, the market reaction this morning has been remarkably muted, as it was this time last week after the referendum was announced. And in a way, nothing has really changed. Although the Greek people have voted in a referendum to reject austerity, there are equally many governments in the Eurogroup who are representing or claim to be representing electorates whom, if you asked them whether they, in a referendum, whether German voters would support debt reduction for Greece, they'd probably vote no. And so, in a way, the sort of democratic clash between Greece and other countries in the Eurozone has to be intermediated now by government negotiation, and what form that negotiation takes, we've yet to see. On Tuesday, a leader summit has been called, and so it's essentially a political decision that needs to be made about ultimately whether or not Syriza should be given what it really wants, which is a restructuring of its sovereign debt.
Some of the market, Alastair, expects some sort of a deal to be in place as early as tomorrow. Do you believe that's possible, or is it just wishful thinking on the market's part?
Clearly not. If we look at the timetable which has emerged since the outcome of the referendum, we know certain fixed events which are going to take place. Eurozone finance ministers had a conference call this morning. The ECB Governing Council will meet this afternoon. That's a key meeting. Merkel and Hollande will meet face-to-face over dinner in Paris, I believe, to discuss the way forward. And there will be a summit of Eurozone leaders on Tuesday evening. It's very unlikely, in my view, that we will see any progress whatsoever before then, and that's your 48 hours.
David, do you expect that a deal could be getting inked by 7th of July, as the Greek Prime Minister claimed it would happen? And what would it mean for markets? Do you think a rally post that?
Well, I think it's inconceivable that an agreement takes place that quickly. I mean, the heads of government are only meeting tomorrow. President Hollande and Chancellor Merkel are meeting today in Paris. I think it'll be it's inconceivable that such a timetable could be met. So we're going into a period now of tremendous uncertainty, particularly with respect to what happens to the Greek banking system and whether the ECB increases or reduces its level of support, liquidity support through the Emergency Liquidity Assistance Programme to the Greek banking system. If that assistance is not forthcoming and if Greek banks find themselves increasingly illiquid, the question really is to what extent or how likely it becomes that the Greek government is forced to introduce some kind of parallel currency that allows it to pay pensions and pay government salaries.
Alastair, is there a concern over how this would turns the tide for other high debt nations, peripheral Europe essentially, or is that region on course to do well?
Well, so far we've seen very little market contagion. We've seen single-digit movement on some peripheral bonds, nothing more than that. A bit of a sell-off in euro stocks, a bit of a sell-off in the euro. This is somewhat in contrast to what we saw a week earlier, when markets taken by surprise reacted significantly more violently than they did to the referendum outcome. So for the time being, steady as one goes, I think is the correct way to look at this. But of course, implications for peripheral countries may depend significantly on what happens in the coming days. If, for example, Greece were to be successful in negotiating new lighter terms for the re-implementation of a program, or the implementation of a new program, as perhaps we should say now, that could, for example, provide a significant boost to support for Podemos in Spain, with, of course, the Spanish general election coming up towards the end of this year or early next year.
David, steady as it goes, that's what at least Alastair thinks is going to be the impact really for periphery economies. But what about the impact on emerging markets like India? How would you correlate what's going on in Greece with the rest of the world, especially, when it comes to emerging markets?
Well, as I said this morning, the market reaction has been remarkably muted. I mean, clearly, the risk of Greece leaving the Eurozone, which is clearly the sort of ultimate risk in this environment, has considerably less contagion effects than it would have done in 2012 before the ECB and the Eurozone itself were able to put in a number of structural pillars to support the Eurozone in the event of an event like this. And so those supports have allowed the contagion risk into emerging markets to be remarkably mute. This morning, for example, the biggest kind of move in currency markets around the emerging world was the Russian ruble, but that was because of a reasonably sharp fall in the oil price that we've seen since the end of last week, which in turn was a reaction to the fact that the euro has weakened and the dollar has strengthened. And when the dollar strengthens, the oil price, by definition almost, tends to fall.
Alastair, let's talk about the bigger picture. Do you believe that this vote also makes long-standing relations between the EU and the Greek government sour for further negotiations? Will either side blink, given the baggage that comes with it?
One of the arguably positive developments we've seen this morning is that Yanis Varoufakis, the Greek finance minister, has, well, let's say resigned. It does look rather like he was pushed from his own statement on his blog. Removing him from the negotiations may help, but let's keep in mind that Eurozone leaders have also become very frustrated by Alexis Tsipras over the past weeks and what they see as the erratic Greek negotiating style. So a great deal will hinge on the spirit and indeed the words which the Greeks bring back to the table with them when they come back to the table, and indeed the rhetoric which emanates more generally from Athens in the coming days.
So Newton, talking about that larger picture once again, is this the end of the saga, or is there more to come, given that two more key payment due dates are also lined up in July and August?
Well, I think there are several scenarios which one can realistically paint going forwards, but just let me take two which are, if you like, at the extremes. I mentioned earlier that the ECB meeting it could be key. A great deal depends on what happens over the ELA programme under which the ECB is supporting the Greek banks. Now, last week we saw press reports in Frankfurter Allgemeine Zeitung that the Greeks may actually already be in default to the ECB to the tune of something like €500 million. The ECB was reportedly investigating this. If that proves to be the case, it may be very difficult to continue ELA even now, and clearly that could bring this crisis to a denouement very speedily indeed. On the other hand, we may see the Europeans coming to some sort of accommodation which allows Greece to roll over its debt payments due on the 19-20 July, which you mentioned a moment ago, and while negotiations are continuing. And this could yet drag out for some time. It's very interesting to note that according to the bookmakers this morning, Greece is not going to leave the Eurozone, but not this year. So there are certainly some people out there who foresee this dragging on for some time to come. And even if there is a deal in the imminent future, there are many who believe we will come back to a crisis point not too long thereafter because of the difficulties which all Greek governments have found trying to reform a clientist and, let's say it, corrupt in the sense of not collecting taxes political system there, which does not work well. And unless there are fundamental reforms at that level, another Greek crisis may be imminent even if we resolve the immediate issues.
Alastair, in changing course from economics to politics, how do you think this could change the political landscape in Europe? Will more questions be raised about the euro and its effectiveness as a monetary union?
Well, clearly there are a lot of skeptics out there over the survivability of the euro. There always have been. There likely always will be up until the time when there is genuine political and economic union in the Eurozone. And I don't imagine for one moment that that's going to happen remotely in my lifetime. So the question marks will remain. Now, again, I think we can take two scenarios here. There have been doubts that if Greece were to leave now, it would be a disaster for the Eurozone and we would see a breakup in the imminent future. I think those doubts have largely been quelled of late. Let's hope if we do see a Grexit that proves to be the case. On the other hand, there are those, and I think we can include certain finance ministers in this category, who believe firmly that if there are major concessions to the Greeks now, if the Greeks are allowed to, in the eyes of many Europeans, allowed to continue to break the rules, that too will be bad news for the Eurozone because other peripherals will believe that they can then do the same. And I think that would raise significant question marks over the budget sustainability, the deficit sustainability of Italy in the future, where Euroscepticism has grown significantly over the past 3 years and where most of the major opposition parties to Matteo Renzi's government are now adopting firmly Eurosceptic stances.
David, we'll let you have the final word then. And this question is really about currencies. We've seen the dollar for one gain a fair amount of ground. What's your view on EM currencies in light of the strengthening dollar?
Well, almost by definition, when the dollar strengthens, emerging markets currencies need to weaken against the dollar. I mean, that's almost just an arithmetic fact of life. If you think about the purchasing power of a Turkish lira or of a South African rand across a range of currencies, when the Turkish lira denominated in US dollars, that Turkish lira's price against the dollar has to fall when the dollar rises against other currencies. It's just a kind of arithmetic thing. So dollar strength tends to be bad news for emerging market currencies, but there's also something deeper going on, which refers back to comments I made earlier, that no matter which element of GDP you look at, it's difficult to see how growth in emerging markets will accelerate. Net exports is under stress because of China, because of a fall in the growth rate of world trade. Government spending is under stress because of the need that developing countries have to tighten fiscal policy in order to shore up their financial credibility. And private domestic spending is under stress because there's relatively little risk appetite in the domestic banking systems in many emerging economies. With that sort of broken growth model, if I can put it that way, if a country doesn't have a really coherent structural reform agenda, the only residual solution or the only residual outcome to a sort of broken growth model is that the economy gets repriced through exchange rate depreciation. And so I think we are still in a process where many emerging market currencies do need to weaken further in order to reach a level where their currencies become a kind of catalyst for capital inflows and a source of support for net exports in these economies.
All right, gentlemen, we leave it at that. Both of you, Alastair Newton and David Lubin, thanks so much for taking time out for us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.